it's moved, we've seen an 8x move.
Yep.
And I believe you see at least the possibility of something like that occurring.
Well, if something happens since early 1970s, before gold even started trading in the U.S., which was 1975, gold went from the low 30s to $200. Okay, during that time, by the way, the stock market from 73 to 74 was in a major down move. So while gold was going up, stock market was going down. Remember that. Okay, that was a seven-fold move almost for gold. Okay, next one was in the 1976 low. Gold corrected 50%, got down to like $103. It went up to 850. It's an eightfold move over 3.5 years. Okay, remember that one. Okay, stock market was in a sideways range all during that time, so it was not participating. Gold was doing something on its own. Okay, then we have another move from 1999 2000 period where gold was trading at 250 an ounce and went to 1920 over a 10-11 year period, with a quick interruption involving 3 weeks within the month of October of 2008. Where you had a quick crash in gold that was sympathetic with the stock market. But then the sympathy ended and gold just took off again and waved goodbye to the stock market, which took 4 years to get back to its old high. It took gold 4 months to get back to its high. And gold went up eightfold again. So we have an eightfold, and a near sevenfold. Okay, our bear market low was 1,050 something. Actually, I think 1,040 something in late 2015. So we've doubled. Okay. And then you went into this boring range. If you stand back and look at it on a logarithmic scale chart going back 50 years, you could hardly see a decline in gold. All you see is it's a sleeping market up here, between 1,700 roughly and 2,000, with a brief interruption below. If it goes another eightfold move, which is to say, it did what it did 3 times before, big deal. We certainly have the fundamentals in the background that could cause that. We all know that. But if that occurred, gold would be $8,000 an ounce. Okay, fine. Let's say that's all it does, which I find kind of hard to believe because we're in a situation in the world right now, financially, market-wise, every political-wise even, that argues for something more. But let's just say an eightfold move. Go back and study the ratio of silver as a percent of the price of gold, and you'll see that there was one time it was 6.5% the price of gold. A couple times it was well over 4%. Many times it was 3%. And a majority of the years, that 50-year period, at least traded over 2% of the price of gold. Okay, right now silver is about 1.3% the price of gold. If silver merely went up and did the routine of going to, let's say, 2.1% of the price of gold, which is where it's been, like of the last 50 years, it's been the majority of the months of those years have seen that sort of ratio. Okay. Then silver, if gold were 8,000, silver would be, $160 plus. 20 to 160, pretty good multiple. If silver moved back to 3% of the price of gold, which again is not extraordinary when you look back over 50 years, it's done it multiple times. Silver would be $210 an ounce if gold just went to 8,000. So again, I'm not saying it's got to happen, but if the gold trend is in fact merely in pause in the middle of yet another 7 to 8-fold move, then the silver gold ratio, if silver is in fact turned versus gold, which we argue it has, then it wouldn't be shocking to see silver go up to 3% the price of gold. Well, good grief, at $8,000 gold, that means find me a market that can go up that much from $20 to 200 and something without using leverage and not be unrealistic in so doing in terms of what it's done in the past on a ratio basis. So it's entirely reasonable that's happened. The issue now is getting us up out of this recent pullback in silver and gold. We think silver's given enough positives. The silver gold ratio has given us some positives. We're waiting on gold to give us that one positive, one remaining. And that's a daily close in our reports that we specified. It's back up where we were a week ago, but just $1 higher.
And so with all that said, is there any single focus point that you're looking at that would be driving that? Is it just some of these government bond markets, or if there is an acknowledgement of a more severe situation and the Fed has led on so far, or what do you keep your eyes focused on that might
It's
be?
both. It's both. It's a paper asset bubble. First off, it's bigger than any stock market bubble we've ever had in terms of multiples that occurred over 11-year period, 12-year period, 2009 through 2012, thanks to Ben Bernanke, who just got his Nobel Prize for printing money. And he's a good guy to listen to because he just said the other day, oh, no, the problems, the debt problems now are nothing compared to what they were back then. Well, he's the same guy who told us, but a lot of people, not a lot of people, a few select people were saying, we've got a real estate bubble, it's going to collapse. He said, oh, there's no real estate bubble. Okay, so he's the same guy. So he's maybe a perfect negative indicator. But now all of a sudden, we thought it might be the stock market decline that would cause the Fed to change its view, because the stock market decline is not going to occur just as some mathematical thing. It's going to have real world implications. It's going to hurt people, particularly when the bubble is not just a doubling. After all, from 2003 to 2007, the S&P doubled. And then the bear market that followed, we considered to be a disaster. We've just gone up 7-fold in the S&P and 16-fold in the NASDAQ. If that bubble breaks, what's on the other side of that compared to the 2009 situation? So the central banks have created a problem. They've now undone the problem by pricking the balloon. And as their perception is, oh my gosh, we've gone too far, which now is becoming a chorus out there. In fact, yesterday, 2 Fed governors, including Brainerd, said, oh, we might have to pause a little bit. We might have to think about this. So they're getting the message. Well, that's not built into the gold market yet. Still people thinking that, oh, you can't fight the Fed, which is not a truism, by the way, in any stretch of the imagination. So, but now all of a sudden we have the new variable, which frankly we didn't expect. We expected the bond market to go down hard and rates to go up, but not to have the crisis implications that we're seeing out of the UK, where illiquidity becomes the attribute. Because illiquidity that's a disastrous word. Decline, one thing. Illiquidity, that's another. And that's when you get the panic mode quickly. So that's a new variable that suddenly jumped on the screen. And it could be something that takes us from incremental to chaos theory.